Welcome back. You're still watching Finweek Money Matters. Remember, this is the show that helps you manage your finances. The South African Reserve Bank announced its decision to hike interest rates by 25 basis points yesterday, and there may be more to come. Joining me in studio to discuss what this means for you and the economy, and maybe if you should be thinking about changing your investment strategy. I've got Alex Smith, economist at FNB, and joining us from our Cape Town studio is Schalk Louw, portfolio manager at PSG Wealth. Gentlemen, lovely to have you both. I'm going to start right here, the Johannesburg studio, with you, Alex. Did it come as a surprise to you? 25 basis points. Everybody's been saying, look at the state of our economy. We're really not doing well in terms of growth. Your view?
It was a little bit of a surprise. We had expected that they would probably only lift rates early next year. But I think we all know that they're in a hiking cycle. What I think was quite interesting about the move was that it was a little bit more preemptive than I think most people had been anticipating. So it seems that the SARB's reaction function is gradually changing towards one in which they're trying to be a little bit ahead of the curve. They're trying to look through into the future and see what's happening with inflation and deal with that inflation before it starts to become too much of an issue. Because of course right now inflation is relatively low. But they're looking through into next year, they're seeing a lot of inflation risk. And that's why they decided to hike interest rates yesterday. So I think from that perspective, it's actually quite positive because even from a growth perspective, it suggests that what they're trying to do is drip feed interest rate hikes into the economy rather than risk being behind the curve and then having to hike rates aggressively. And that can typically weigh more on economic growth than gradual interest rate hiking.
Schalk, let me come to you in Cape Town. As you heard Alex said, it's probably better to be ahead of the curve there, but 50 basis points was a question that was asked during the MPC meeting as to whether or not this is something that they had maybe thought about, and the Reserve Bank governor said no. So given that hiking cycle, we know that we are in one at the moment. What are some of the considerations that investors should keep in mind?
Well, I think currently, my view is if you look at the interest rates in general, over the last, let's call it 40-odd years, if you take it the economic growth cycle over that, let's call it 40 years, in an increasing rate environment, our economy has definitely struggled. You're looking at about a third of the GDP growth in a raising interest rate environment. So I would think in general, interest rate hike is never good, but I think I think we've seen from the Fed side that they're looking at a prolonged hiking period. So I think the gradual raise in interest rates might not be a bad thing, rather than sitting with huge inflation problems in, let's call it, next year or two.
Alex, everybody's been saying they're watching the US Federal Reserve, but there are certain things that they should be watching. What exactly are you paying attention to, and how do you think this is going to filter into the South African economy? Yeah.
Okay, look, I think it's worth bearing in mind that the SARB has hiked interest rates now by 125 basis points since the beginning of last year. And this is before the Fed has actually lifted interest rates, although the Fed has become less accommodative because it's not doing quantitative easing anymore. But clearly the SARB is considering homegrown risks as much as it's considering the Fed. So I think if we begin with the Fed, we need to think about why does the Fed matter? The Fed matters because it affects the rand-dollar exchange rate, and that has inflationary implications through higher imported costs if there's a depreciation there. So we need to consider the rand exchange rate in particular, but we also need to consider the risks at the moment emanating from food prices. Bear in mind that we're experiencing a very severe drought, and that's pushing up food prices. And the other risk out there at the moment is electricity prices. Remember, Eskom has asked for a significant tariff increase of about 16.5% around the middle of next year. So if they're granted that by NERSA, that will also push up inflation quite a lot. So ultimately, bear in mind, SARB's target is inflation, and that's what they're concerned about. Everything else is peripheral and is only considered insofar as it affects the inflation outlook. And at the moment, those are the three big inflation risks out there.
Schalk, is an interest rate hike positive for the stock market, and which particular sectors may benefit from this, or asset classes for that matter?
I think the short answer is definitely no. I mean, let's for 1 second, I'm going to put away my telescope and look at my rearview mirror again. If you look at the period from 1973 up to now, and when I talk about it, I talked about a rising interest rate environment and a declining interest rate environment. A rising interest rate environment is, let's call it, that first time you see interest rates hike, pretty much what we've seen last year, February, up to the point where it actually started declining for the first time. Now, firstly, over that, let's call it 40-odd years, a typical period is about, let's call it 32, 33 months. So it's not a short period. It's never, we'll see a quick rise in interest rate. So it's fairly prolonged. And over that period, let's call it in a rising interest rate environment, over this 40-year period, equities has never been able to outperform money market in this let's call it interest rate hike environment. Exactly the flip side of the coin is true. When interest rates start declining, money market has never been able to outperform the stock market in that period. So I'm fairly bearish currently looking at where we are. You're looking at a interest rate hike environment. Then secondly, we'll be sitting on currently trading at a 20-year high in terms of PE ratios. And I know, we're talking about, take out the Naspers and SA breweries. Even if you take that out, the remaining, let's call it top 40 shares, is still trading about 64%, higher than the average historic PEs. So at an environment where we're trading at an all-time, well, let's call it a 20-year high in terms of PE ratios, earnings coming in only, well, it's declining by 8% per annum. I think the market is currently a bit too high, and this might hurt equities over the long term.
Gentlemen, unfortunately, we're going to have to leave it there. This conversation was much too short, but we will be picking this up again. Certainly, this will continue to be a big talking point. Thanks so much to Alex Smith. He's an economist at FNB and Schalk Louw, portfolio manager at PSG Wealth. Do remember that you can go and get yourself a copy of this magazine. It's available at your nearest store, or you can also get it online. That's it from the Finweek Money Matters team. We'll see you again same time next week. Have a great weekend.